Hi, everyone. So welcome to the live stream today. Very much excited for having you on our third discussion in the series under short-term decisions in management accounting. And I'm very much excited about today's session because we want to look at two of the key important principles or concepts in management accounting and under short-term decision. And that is going to be make or buy decision, which is closely linked to outsourcing decision. And I see some of you guys joining the stream, and welcome to the stream. I'm going to share my screen with you real quick, then we continue. So in case you missed the discussion on relevant cost analysis, we did a two-part session on the relevant cost analysis and solve a question in that. You can check the description of this video. You will see the part 1 and the part 2 of the discussion we did on relevant cost analysis. So you can watch that video as we continue with our discussion today, looking at the make or buy decision, because this is also one of the critical decisions that we need to know about. I see some of you guys joining on YouTube. You are welcome. When you join, give us a thumbs up on the video, share the video, let us reach as many students as possible. And I see some of you guys also joining on Facebook. Welcome to the live stream. Comment in the chat box. Let us know where you are watching us from. And most importantly, remember I told you that from next month, we want to dedicate the whole of next month to revision session. So let me know in the comment box, in the chat box, the topics you would want me to cover during the revision sessions, and then the kind of questions you would want me to solve with you guys during the revision session as you prepare yourself to ultimately pass the examination. So welcome to the live stream today. I see some comments coming in on YouTube. Desmond Danso Dankwa said, good evening, sir. Hope you are doing fine today. Yes, I am flourishing. Thank you. And I hope you are also doing well. Funto Bello said, good evening, sir. Trust your day was fine. Yes, my day is great always. K, wise for success, powerful. Yes, Sami, you're welcome. Thank you for joining us on the live stream. So I want to share my screen with you real quick as we continue with the discussion in that case. Let me share my screen with you real quick and let's go. Let's see what we got here. Okay, so we're here now. So let me open just my slide today. Okay. So remember that the discussion we are having is in the short-term decisions. And I made mention of the fact that when it comes to the short-term decisions, there are a number of decisions that we will have to take into consideration, and we will have to look at it in relation to that. So I spoke about a break-even analysis, make or buy decision, shutdown decisions, further processing decision, relevant costing analysis, limiting factor analysis, throughput accounting, outsourcing decisions, and then pricing decisions. All these are short-term decisions that we need to know about, that we need to focus on and look at it very well in relation to that. So let's go straight up into our discussion for today, and that is going to be make or buy. Make or buy. Now, this is one of the critical short-term decision-making techniques that organizations use to ultimately make outsourcing decisions. Because every organization, in order to improve productivity and increase its profitability, would want to find out whether they can outsource some of their production or the services that they do in-house. Now, when making the outsourcing decisions, there are two things we need to look out for. We need to look at the financial aspect of the outsourcing decision, and then the non-financial aspect of the decision that we are making. In other words, we need to consider the quantitative analysis. We need to undertake a quantitative analysis as well as look at the qualitative factors or analysis. So before we reach the decision rule concerning whether we should outsource or not to outsource, whether we should make our own product or buy it from a third-party organization, then we would have to look at the financial or the quantitative analysis and then the qualitative analysis. In the first part of our discussion, we're going to be looking at the issue about the quantitative analysis, so the make or buy decision. So make or buy decision simply has to do with where an organization decides whether to manufacture the product in-house or to produce the product in-house or to allow a third-party organization to buy it from. But when organizations are making the make or buy decision, they can be making the make or buy decision based on the resources that are available to the organization. So resource availability. Now, when we talk about resource availability, you know that organizations use various resources in the production of goods and services. So they can have machine hours, or if you want, the machine capacity. Another resources could be labor hours. Another resources could also be maybe the funding or other things. But or maybe materials. Now, we're going to be focusing our discussion around everything else except funding, because we will look at the funding bit later on in our discussion in that case. We'll look at the funding bit later on in our discussion in that case. So the question then we ask ourselves is, okay, so how do we get all these across, and how do we undertake all of these decisions in that case? How do we actually undertake these decisions in that case? So organization would have to consider, what resources do we have? Now, based on the resources availability, an entity may have limited resources or unlimited resources. I want you to stay with me carefully here. So when we are making the make or buy decision, the entity doesn't just get up and make the decision. Instead, the entity would make that decision under two circumstances. Either the entity is making that decision because it has a limited resources available, or it is making the decision because it has unlimited resources available. It is very important for us to understand the position that the entity has in terms of resources availability, because that would guide or that would determine whether we will take into consideration which factors, or factor A or factor B or not. So for instance, if the entity has unlimited resources, which means that the entity doesn't have any problem about materials, the entity doesn't have problems about labor, the entity doesn't have problem about machine capacity. So the entity is just looking at, oh, instead of we doing the product in-house, can we look for, or can we get another firm outside to do the product for us? So if the entity has unlimited resources, then the make or buy decision will be made by comparing the marginal cost of making the product, with the buy-in price. Now, I want you to stay with me very carefully here about this discussion, because it's very, very important. So the organization has unlimited resources. Okay, but they are just looking at, can we outsource one of the functions to an outside firm to undertake for us, so that we can increase our productivity as an organization in that case. So in that case, what the organization would do is to simply compare the marginal cost of making the product with the buying price. Now, when we talk about the marginal cost of making the product, it can include two things. It can include two things. That is the variable costs as well as specific fixed cost. The variable cost as well as the specific fixed cost. In other words, if we are producing this product, how much material cost do we pay? How much labor cost do we pay? How much direct expenses do we pay? How much variable production overheads do we pay? All those things will come under the variable cost. Will come under the variable cost. Then the variable cost plus specific fixed cost. Now, the specific fixed cost has to do with the fixed cost that the entity will incur when it decides to make the product in-house. In other words, in the making of the maker or in deciding whether to make the product in-house or to outsource, the organization does not consider general overheads. So general overheads is not considered when making the decision about make or buy. General overheads is not considered when making the decision about make or buy. So what are we saying here? What we are saying here is that an entity wants to decide whether it should make the product in-house or outsource. The decision of whether it should make it in-house or outsource is dependent on whether the entity has limited resources, the entity is constrained, or unlimited resources. The entity has no constraints. Where the entity has no limited resources, in other words, the entity has no constraints, then we say that the make or buy decision will be made by comparing the marginal cost of making the product in-house with the buy-in price. And we say that the marginal cost of making the product in-house shall be the variable cost of making the product plus specific fixed cost. Plus specific fixed cost. What it means then is that we do not consider, how do we call it, general overheads in making of the decision. We don't consider general overheads. So what then is the decision rule in that case? Simple. So where the cost of making, the marginal cost of making the product is greater than the buy-in price, then ultimately, what do? You buy. Okay? You spend a lot of money to produce the product, and someone can give you the same product at a lower price. So if it is just about prices, you go for it. Now, remember I told you that the making of the outsourcing decision, there are two factors we look at: the quantitative analysis, the financial aspects, and then the qualitative analysis, because it is not just about price for us to make the outsourcing decision. We would have to look at some other factors which we will get into later, but we would have to look at the quality of the product that the supplier is going to give us. We would have to look at the expertise of the supplier in that particular product. We would have to look at the experience of the supplier for that particular product. We would have to look at the reputation of the supplier for that particular product. We would have to look at their delivery time or lead time in that case. We will have to look at the discounts that they are going to be offering or other terms of service. All these are the qualitative factors we will consider. But for now, in the meantime, we are just looking at the financial aspect or the qualitative and the quantitative analysis. So if the cost of making the product in-house, assuming the entity has no limited resources, the entity has no constraints, then if the cost of making the product in-house is higher than the buy-in price, then we buy. So the reverse is true. If the marginal cost is less than the buy-in price, why not? You make it in-house. We make it in-house in that case. So that is the idea about how we make this particular decision. But again, like I said, we will not be just making the decision looking at the price, because there are times when it will be cheaper for us to do the thing in-house, but it will be better to let another firm do it so that we can focus on our core activities or core operations as an organization. So there are times when on a qualitative level, even though the making of the product is cheaper than the outsourcing, the entity will still outsource because the entity would want to focus on its core activities or its core operations in order to improve upon its productivity as an organization. So this is how we make the decision when an entity has unlimited resources. There are no constraints. We don't have any material issues, any labor issues. There are no limitations. Then we just look at the marginal cost of making the product as against the buying price. Any questions? I see some of you guys joining the stream on Facebook as well as on YouTube. You are welcome to the live stream. Smash the like button when you join and share the video. Let us reach as many students as possible. It helps us a lot to make the video more engaging, and YouTube and Facebook will be able to push the video so we can get to a lot of students who need these contents. Remember that in case you missed our discussion on relevant cost analysis, we did a two-part series on that. You can check the description of this video and you'll be able to watch that one as well, as that is also a critical topic in the short-term decisions. And comment in the chat box, let me know where you are watching us from and also any questions you have for me. I see some questions coming in. John Malongo said, good evening, sir. I have many questions concerning the session today. Okay. Isaac Kofi said, God bless you so much. God bless you for such a wonderful work. Amen. God bless you too. John said, what actually distinguishes this call short-term decision? Make or buy, shutdown, and shutdown point. What is the point of reference concerning this short-term decision? I don't understand your question, John. I don't know what exactly you are talking about. Maybe you can retype your question, then I can provide you with a better answer. Because what actually distinguishes this called short-term decision? Make or buy, short-term, shutdown, and shutdown point. I don't understand your question. So please restate it. Let's see. Toby said, good evening, sir. Good evening, Toby. I hope you're doing well. Then John came back to say, it seems that marginal costing principle and short-term decisions are inseparable. Why? We've mentioned this already, that marginal costing principle is a basic principle that cuts across. There are two concepts that actually cut across really more when it comes to management accounting. One of them is the marginal costing principle, because the marginal costing principle cut across in the various topics, in the various subjects, when it comes to dealing with the issue about break-even analysis, make or buy, relevant cost analysis, shutdown decision, and all of those things. You need to make sure that you get that coming in that case. Then absorption costing is also a principle that is critical in management accounting, because you'll be using that concept in budgeting, you'll be using that concept in various analysis. So the marginal costing principle is a fundamental principle that we use in making various short-term decisions, and it's actually a basis for making a lot of decisions in management accounting. Then Augustine A. Barton said, hi. Hello, Augustine. You're welcome. Mavis Amito said, good evening, sir. Good evening, Mavis. I hope you're doing well. Mafu Ejace give us an emoji in the chat. George Ampofo said, guys, please smash the like button. Oh. We need more management accounting lectures on here. Okay, smash, you smash. All right, George, thank you very much. So smash the like button. Let's get more engagement on the video, and then let's continue with the discussion. So that is what we do if the entity has unlimited resources, okay? So what if the entity has limited resources? In other words, the entity cannot get as much resources as required to be able to meet demands, as much resources as required to be able to meet demand. Right, Facebook, thank you very much. I see some of you smashing the like button and then the heart button on Facebook. Thank you very much. Thank you very much. We really appreciate that, and it really helps the channel to promote it and grow and meet other people. So when the entity has a limited resources, stay with me carefully here. That means that probably the entity is producing 2 products. So whatever, let's say, what products can we produce? Let's say we can produce Sobolo. So let's say we can produce Sobolo and ice kinky. Sobolo and ice kinky. These are the 2 products that we will produce as a company, Sobolo and ice kinky. Now, I don't know, but in Sobolo, I don't know if we use sugar in Sobolo. I don't think they use sugar in Sobolo, but let's just make something up. Let's say they use sugar in Sobolo. I don't know, but ice kinky, let's say ice kinky, we have to use sugar all the time. Let's say milk, maybe milk in Sobolo and milk in whatever, ice kinky. So let's say milk or sugar. Let's choose one. Let's go for sugar. So it will be weird to have sugar in Sobolo because of the ginger. And milk will also be weird though, but let's just assume that they use one of them. So let's say that the organization manufactures 2 products or produces 2 products, Sobolo and ice kinky. So let's say that one of the raw materials for the Sobolo and ice kinky, it's whatever. Let's say it's sugar, okay, or milk, all right? Just an assumption. It doesn't mean it's true, but just an assumption. Now, let's say that for the period under consideration, the entity is limited to the kilograms of sugar that it can obtain for the period under consideration, or the liters of milk it can obtain for the period under consideration. Hence, it means that we are probably limited to only maybe 100 liters of milk for the period, but if we want to produce Sobolo and ice kinky, all the quantities we require, we cannot meet the demand in-house, which means that we need to decide how many Sobolo must we make in-house and how many ice kinkys can we make in-house and which one must we outsource. So when making the decision about whether to make the product in-house or whether to outsource the product, and the issue in relation to resources are limited, that means that we have to take into consideration the limiting factor concept. So in that case, what is going to happen is that I'm going to have my Sobolo coming up. I'm going to have my ice kinky coming in. Stay with me carefully on that. Sobolo and ice kinky. Then we're going to bring the selling price per unit up. Oh, that's too much. XX coming in. Then we're going to bring the variable cost there, and that is going to give us what? The contribution. So you realize that the marginal cost principle is coming in here again, the contribution. What does that mean? What does that mean? It means that we're going to be bringing the usage of the limiting factor per unit. That's going to come. Now we're going to divide that, okay? Then we'll get a contribution per the limiting factor. Contribution per limiting factor. Once we get a contribution per the limiting factor, what do? We then rank the products. Now, stay with me. I want you to stay with me carefully here because I don't want you to jump over and I don't want you to really get missing. So make sure you stay with me carefully here. Because when it comes to this one, we're going to rank. Now, when we rank, the products that gives us the highest contribution per limiting factor is produced in-house with the limited resources. If there is any amount left, we will produce the other one, then the difference will be outsourced. So what are we saying? NB, the product with the highest, contribution per limiting factor is produced first. Is produced first. That's the concept. That's the concept. What does that mean here? It means that when making the decision about make or buy, we don't, and it's about limiting factor or resources are limited, we don't consider specific fixed costs. So here, specific fixed cost is not considered. Specific fixed cost is not considered since it will be incurred irrespective of the number of outputs or the number of units produced in-house. Irrespective of the number of units produced in-house. So let's contextualize, please. Remember, I told you that when resources are unlimited, we look at the marginal cost of making the product. And we said the marginal cost of making the product is the variable cost plus the specific fixed cost. And we made mention of the fact that you're going to compare the marginal cost of making the product, which is the summation of the variable cost and the specific fixed cost. When you compare that with the buy-in price, if your marginal cost of making the product is greater than the buy-in price, then what do? You buy the product. But if your marginal cost of making the product is less than the buy-in price, what do? You make the product. However, where the entity has limited resources, the make or buy decision is based on the product that gives us the highest returns per the limiting factor. The product that gives us the highest returns in terms of contribution per the limiting factor. The product that gives us the highest returns per limiting factor. So that we're going to determine the contribution, then we bring in the usage of the limiting factor per unit, then we get the contribution per the limiting factor. Once we have the contribution per the limiting factor, you're going to rank so that you produce the product with the highest contribution per limiting factor first. And like I said, we will not consider the specific fixed cost. Why? Because the specific fixed cost will be incurred anyway, is irrespective of the quantity of the units that is being produced in-house. Will be incurred anyways, irrespective of the quantity of the units of the products that is made in-house. That is what you have to understand when we talk about the issue in relation to the make or buy. The make or buy. Any questions, please? Any questions, please? Any questions, please? Any questions, please? Comment in the chat box. Let me know the questions you have as we pick a question real quick to explain the concept and use the concept in that case so that we can touch on outsourcing decision as well. So comment in the chat box any questions you have for me. Okay, so it means everybody good. It means everybody good. Right, so let's now look at a question on the make or buy and see exactly how's that going to be. So let's go, let me share my screen with you here. Let's pick up my book in Man Accounting. And I think in Make or Buy, that should be on page, let's see, page 127. 127. Okay, so here I am. Now we want to look at this question here under the Make or Buy. Want to look at this question.